Over the past few years, one ETF quietly became one of the most talked about investments in Canada, CASH.TO. When interest rates surged, it offered yields that rivaled GICs, with daily liquidity and simple access inside a TFSA. For many Canadians, it felt like a smarter savings account. But now it's 2026. Interest rates are shifting. Markets are evolving. And the big question is CASH.TO still worth holding? In this video, we are going to break down what CASH.TO actually is, how it works, what happens if rates fall, and who it makes sense for in 2026. Let's start with what CASH.TO actually does. CASH.TO is a high-interest savings ETF. It pools investor money and deposits it into high-interest accounts at major Canadian banks. The fund earns interest from those deposits and distributes it to investors monthly. The price typically stays close to $50 per unit, and the return comes from interest payments, not price appreciation. In simple terms, it's designed to behave like a savings account that trades on the stock exchange. During the peak rate environment of 2023 and 2024, CASH.TO became extremely popular because yields were attractive, often comparable to short-term GICs, without locking up your money. Investors could buy and sell it any time markets were open. But 2026 is a different environment. If the Bank of Canada lowers rates, the yield on CASH.TO will fall as well. It adjusts with prevailing interest rates. That means it is not a guaranteed long-term high return. It reflects whatever short-term rates are in the economy. So the real question isn't whether CASH.TO is good or bad. It's whether it matches your financial goal. If you are saving for something in the next 1 to 3 years, a home down payment, tuition, a large purchase, CASH.TO still makes sense. It offers capital stability, monthly income, and liquidity. Inside a TFSA, the interest is tax-free. Compared to leaving cash uninvested in a brokerage account, it's more efficient. But if your goal is long-term wealth building, retirement 20 years away, CASH.TO is unlikely to outperform equities over time. Historically, stocks have delivered significantly higher returns than cash equivalents. Holding too much in cash long-term may protect you from volatility, but it also limits growth. Another factor to consider in 2026 is competition. Banks are still offering promotional high-interest savings rates. GIC rates may remain competitive depending on the rate environment. And some brokerages offer integrated high-interest savings accounts with minimal friction. CASH.TO is not the only place to park short-term funds. Now let's address the safety question. CASH.TO holds deposits at major Canadian financial institutions. However, unlike a traditional savings account, it is not directly CDIC insured in your name. The structure differs. That doesn't mean it's unsafe, but it does mean it's not identical to holding cash in a personal insured bank account. For most investors, the risk profile remains low, but understanding the structure matters. Another important nuance is liquidity mechanics. While CASH.TO trades like a stock, its market price can fluctuate slightly during the month due to accrued interest and trading spreads. It generally trends back towards its base value after monthly distributions. For long-term holders, this is usually minor, but for short-term traders attempting to time distributions, small price movements can matter. So who should hold CASH.TO in 2026? If you have short-term goals, if you want to reduce portfolio volatility, if you are temporarily parking funds while waiting to deploy them into markets, if you value liquidity over long-term growth. Who should not rely on CASH.TO? Long-term investors seeking maximum growth. Investors expecting it to behave like a stock ETF. Those who believe it will permanently deliver high yields regardless of rate changes. In 2026, CASH.TO remains a tool, not a strategy. It's excellent for capital preservation, it's inefficient for aggressive wealth building. And perhaps the biggest mistake Canadians make is not misunderstanding CASH.TO, but misunderstanding their own timeline. If you need the money soon, stability matters more than return. If you don't need the money for decades, growth matters more than stability. CASH.TO is still worth it if it matches your objective. But like any financial product, its value depends entirely on how and why you use it. If you found this helpful, subscribe to Wealth Simplified, where we break down Canadian investing clearly, calmly, and without the noise.